Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent licensed in all 50 states. We are honored and thrilled and proud to have back a previous guest that really needs no introduction. If I tell you her name, which I'm going to do in a couple seconds, you don't know who that is, then shame on you, and I'm not sure what rock you've been living under. Her name is Terry Savage. Go to terrysavage.com. We'll have the full bio and all the stuff, but she is a goddess of finance. In all ways, I'm telling you. Terry, so happy to have you back. Thanks for joining me again.
I'm glad to be back with you, Stan. A lot going on.
Yeah, let's jump in. If people want to find out about me and you, they know where to do that. But they tune into this when we start talking because they know we're going to have a really good conversation that's brutal facts and hitting on topics that people are really concerned about. So go ahead.
Okay. Well, I want to issue 2 warnings today. And now I'm going to tell everybody here. I don't know how Stan's. I kind of mentioned this to him. He said, what do you want to talk about? I said, I've got some warnings, but I kind of want to surprise you later. So don't go away because, Stan's always interviewing everyone else, but he's my go-to resource for my syndicated column, my books and so forth. And I have some things on my mind about annuities. This is a really honest interview. So I'm going to interview Stan, which will result in a good column for me.
Interesting.
And I'm going to ask him to explain some stuff that you may think but I see stuff coming in from my readers and on my Ask Terry blog questions, and I think something's going on in the annuity world. So I'm somewhere down the line, Stan, when you say it's okay, I want to turn the tables.
Well, let's turn them now. I mean, I'll go ahead and blow up the script because when you mentioned that, I'm like, yeah, let's go ahead and do that. But I didn't want to give you my answers or my insights until we started recording because I wanted it to be raw. And I'm going to tell you the truth in my opinion.
I turned you on already. All right. I have some warnings for you all later then. I've got literally, I'm standing by. So if you see me looking down, it just means I'm making notes. Well, let me start with this. So let me explain first. My column is syndicated nationally at terrysavage.com. I have a blog where I answer questions. I try and keep up. I sell nothing. I have no clients. There's no ads on my website. I have a mailing list for stuff that I send out every once in a while. I don't sell my mailing list. I'm fortunate my career in the financial markets has subsidized what I really love to do best, which is help people. Okay. That said, I've sort of noticed one thing. We'll start on this part. Annuities, suddenly there's a lot of discussion, stuff I read about, the American people with the market as we speak about all-time highs have a lot of money in their 401ks. And there comes the rollover time, which we're going to talk about next. But maybe we should give them something inside their 401k in the form of an annuity. So it will help them manage their money better in retirement. And all this discussion about annuities inside 401ks is sort of cast a legitimization of all the salespeople that are out there trying to sell you annuities separately. So what's all the talk about annuities in 401ks? Where does that stand?
Well, it's basic common sense if you think about it from the standpoint of just pure capitalism. There's 11,000 baby boomers turning 65 every single day. It's probably even more than that now. And the annuity companies, life insurance companies issue annuities. They want to get in front of that. Most of the accumulation assets are in the 401k setting. And so they're trying to put their products inside of those 401ks so that people can plan for lifetime income in the future. Now, it's a similar strategy that the government, the Treasury Department, and the IRS put together with qualified longevity annuity contracts and IRAs. They wanted people to be able to plan for lifetime income because Social Security was never put on the planet to be the primary income source for retirement. So QLACs were put on the planet for that reason to use inside of IRAs for lifetime income.
In case we have some not new people, qualified life annuity contracts, but typically those are the kinds of things you buy maybe in your IRA, but to start not at 65 or 67 when you retire, but you say, I'll wait till 80.
No,
Insurance,
that's actually not true. Qualified longevity annuity contracts can literally be purchased. Right now, RMD started at age 72. The reason someone would look at qualified longevity annuity contracts with using IRA assets, you can't buy them in non-IRA assets, obviously, in Roth IRA assets, just qualified IRA type assets. You buy them for lifetime income to start at a future date. It could be 72, 75, 80, 85 is the longest you can go out. You can structure it so that your spouse can be a lifetime income benefit attached to that IRA. And also, that amount of money you put in a qualified longevity annuity contract is not used with your required minimum distribution calculations. But getting back to the original question of why are annuities and 401ks, it's truly a capitalistic play of the tidal wave of money that's coming in front of. They want to get in front of it. Here's my problem with it. Let's cut to the chase. Stan, do you like it? In concept, 30,000-foot view, it makes sense for people to transfer risk for lifetime income. Here's where the problem comes in. You have a limited choice. You have the big boy companies that are, I don't know how, we can surmise how they're getting on the platform, but there's limited choices for lifetime income. Remember, annuities are commodity products. You shop all carriers for the highest contractual guarantees. Those guarantees and those contractual guarantees and those quotes are like a gallon of milk. They change every 7 to 10 days. So give you an example. If some 401k has an option for you to buy a deferred income annuity and they give you 2 choices, there's 30 choices. You should be shopping all 30 carriers, but you're only getting 2. That means you're probably not getting the highest contractual guarantee. And these are contracts and commodities that should be shop for the highest contractual guarantee. You should be squeezing every contractual penny you can. Go to my site like at theannuityman.com and quote it. So in other words, here's what I tell people. If you're getting 2 carriers or 3 carriers offered to you, look at those quotes, then go to my site, run a comparison quote, and see if that is even in the ballpark. My concern, Terry, is the F word. And the F word is not the one you're thinking about. It's the word fiduciary. And fiduciary means that I'm going to do the best for my client. I'm going to put their best interest first ahead of everyone. Now, a lot of people say, do you have that plaque on the wall? I don't need a plaque on the wall. I could have a plaque on the wall that says I'm a good guy. It would mean the same thing. Anyone in the financial business should be putting their client's best interest ahead of themselves every single time. Fiduciary should be a given, like a geometry problem. So the problem is, if we're going to pound our table and say, we're a fiduciary, we have a board of directors and 401k. Well, if you are a fiduciary, then are you giving your employees the choice to find the highest contractual guarantee? Until someone proves to me that they're doing that, I haven't seen that.
All right, but stop for a second. Okay, where all this went was, first of all, a lot of 401ks have high fees, expensive mutual funds, not the best managed funds. Smaller companies, their brother-in-law's an insurance salesman for a big company, and he sold them the 401k, and the brother-in-law's getting, a commission. And so by definition, 401k is your chance to save, tax deferred. It's really a shame when you work for a company that has high cost, bad funds in the 401k. And there's been a lot of lawsuits against companies for not giving you the best stuff. Now they're about to give you, or there's a lot of discussion, are there actually any 401k plans that are allowing these deferred annuities?
Yes.
Okay, already. I mean,
Yes.
are people starting to see this? Because I'm getting questions.
Yeah, they are. And deferred annuities that you're referring to, a typical variable annuity or indexed annuity type strategy, those are starting to show up, which I totally 100% disagree with right now. Because when you're in the accumulation. Let me finish that thought. When you're in the accumulation phase of a 401k, there should be no limitations at all on the upside whatsoever. When you choose an index or a variable annuity, there are limitations on the upside. Now, you can attach an income rider for a guaranteed income stream at a future date, but you're also paying a fee annually in addition to the 401k fee for the life of the policy. In my opinion, you're better off focusing on accumulation during the 401k time period, and then at the end, transferring that money to an immediate annuity for a lifetime income stream at that time, called keeping your powder dry. Keep your powder dry, in my opinion. But again, you have life insurance companies with a huge lobby in DC. They make the NRA look like pikers. They don't need guns. They're huge. They're getting into these 401ks and these defined contribution plans so that you can buy these products, hopefully these package products that have an annual fee. I know there's arguments for that. I'm just telling you, I don't like it. I don't like where
Okay,
it's headed.
well, all right. So folks, you're in a 401k plan and they say, we got this annuity product for you. So you can't lose. They always say that. Well, they
Yeah.
don't say you can't lose, but you won't lose, but you're paying for that. So rule one, and I agree completely. If it's inside your 401k, you do not want to buy an annuity. They're trying to make it look like this will protect you and envelop you and take care of you in retirement, kind of a thing. But if you're still working and accumulating, I was going to say this, rule number one, that's going to be my column, is don't buy one of these annuities because they are laden with fees, limitations on the indexes they track, and you don't need that protection. Just invest your 401k for growth, more conservative as you retire. No, but don't fall for that. Now, what happens in the rollover market? Let me go back.
Well, no, hold on for a second. Hold on.
Stan, I got to be logical. I want to, everybody said, but wait, what about those QLECs? Are any 401ks also offering these kind of deferred? They're like immediate annuities, but you don't start taking them till later. It cuts down on the amount of your account for your RMD. That's the amount in that annuity is not calculated for your RMD. And you could say, I'm buying it to start at 75. I really worry about running out of money at 80. But Stan, are those kind of QLECs being offered in 401k plans to your knowledge?
I hope not. That's for when you have control of your IRA and you want to build up your income floor by purchasing that QLEC after you have finished with the 401k. But let me go backwards a little bit and let me tell you what's happening from a marketing standpoint and a psychological standpoint with these annuities inside of 401ks. They are positioning, in my opinion, these products like target date funds used to be positioned. Okay. They're saying, well, you're going to retire in the future, so you need a lifetime income in the future. The question that you have to ask as a consumer inside that 401k, if you're leaning toward buying that, if the person at the lunch seminar is trying to convince you to do it, is to say, wait a minute, how much are the fees annually if I buy this? Or better than that, is this product irrevocable? If I buy a deferred income annuity inside of a 401k, can I pivot out of it? Or is it, if I rip the knob off the faucet and am I just locked into an income stream down the road? Once again, 401ks, my opinion, are accumulation vehicles. You can always, at the end of that time, pivot and buy an immediate annuity to transition into chapter 2 of your life. What the life insurance companies want you to do, and I'm going to get all kinds of hate mail for this. They want you to do that now. Now, are there arguments for that? Absolutely. But I don't think there's arguments for that in your 401k. There's arguments for that in additional monies outside of that, IRA, non-qualified, Roth, whatever. But 401k should be for growth. And in my opinion, there's not an annuity on the planet type that should be purchased for growth or potential growth.
Okay. So there you have it, folks. That's part one of my question. I'm seeing it inside. It's the camel's nose under the tent, so to speak, for a big financial services company.
Sure.
All right. Absolutely. Now let me just switch. This is for all of you who are going to be approaching retirement from your company. The financial services industry. Look, I started my career as a stockbroker a zillion years ago. I mean, I've been inside the tent a lot. I was a founding member of the Chicago Board Options Exchange. I've been around for a long time. And the industry's done a great thing. But right now, they realize, you talked about the baby boomers turning 65. About that time, they retire at 67 if they wait till full retirement age and so forth. Then we are watching people roll over a huge amount of money or faced with, honey, how do we get 1.3 million? That ought to be enough. Well, let's start spending. Or how do we invest it? And there is an army of people calling themselves things like financial advisors, whatever they're called.
Right.
And they are not fiduciaries unless they will put in writing that they're fiduciary. That is putting your interests first.
Even, by the way, stop,
Always
Terry.
flows
That's worth the
always-
paper it's printed on.
All right, okay, we agree, but wait.
That's garbage.
Okay, now, as in fact, right now, the Department of Labor is trying to come up with a new rule. I don't always said you can't legislate morality. They're trying to come up with a new rule that makes companies responsible for finding people to give you fiduciary advice on your rollover. No one in corporate America, I've sit on a bunch of boards, would ever take on that responsibility of giving you financial advice. They think they did a great job letting you save and matching your contributions. So now you're at the brink. And what I'm hearing, I'm getting a lot of posts, and people don't even know what the names of these annuities are. But you're there, let's just say you have $1 million, and they want you to put, let's back up. The ground rules are, we know that you could take an immediate annuity with some of that money, but you're only 67. The odds are you're going to live 25 years. It's a fixed check, that immediate annuity, and at 3% inflation, it'll be cut, the value of the spending power will be cut in half in 25 years. So you don't want to put a whole, I mean, we'd all love to know we got a fixed check for life, but what will it buy? So we want to be careful about an immediate annuity on the rollover. Maybe some, but I don't know. Stan could talk about that.
Well, let's talk.
But they're also talking to me about my financial advisor. That's a word I hate because it means nothing. Who's trying to make a commission, wants me to buy a single premium indexed annuity, a single premium something annuity. What are the sharks circling these, the fresh blood money that's coming out of 401ks?
Well, let's go backwards a little bit. Let's talk about inflation. There's not an annuity on the planet that addresses inflation, even though you're going to hear that someone has it. They do not. Any type of an annuity that addresses inflation, the annuity company is simply going to lower that initial payment by 30 to 40%, as opposed to the same exact annuity that doesn't have that index, that option that increases.
Let's fight. There is one annuity that you might have that will keep up with inflation.
No, stop, Terry.
It's called Social Security.
Correct.
Okay.
Absolutely. No, absolutely correct. That is.
There you get the cost of living increase. But
that is correct.
Okay.
Social Security is the best inflation annuity on the planet, and there are some pensions out there offered by companies that have good inflation protection as well. But there's not a commercial annuity on the planet that addresses for inflation. The way to address for inflation is you figure out what that income floor is that you need and the gap that needs to be filled, and use the least amount of money to solve for that gap. You can go to my site and run reverse engineer quotes to do that, period. But here's a couple things that people need to understand. The annuity industry, when I talk about that, that's the National Association of Insurance Commissioners, that every state has one. They recommend no more than 50% of your investable assets should be put in annuities. That's not including your house, property, cars, and guitars. That's your investable assets. So if you have $1.3 million, as you said, or $1.1 million coming out of a 401k, the annuity industry suggests that you not use more than half. Doesn't mean you have to use half, but if someone's coming to you and say, let's take that whole shooting match, that whole amount, and roll it into an indexed annuity and get an upfront bonus, you can't be that stupid. You cannot fall for that, because number one, the annuity agent, in order to get that through, has to doctor the application to show that the net worth and the investable assets are not more than 50-ish%. So be very careful out there. There's a lot of people that are trying to take the entire amount. I always tell people with annuities, remember that they're contracts. You use the least amount of money humanly possible to solve for the contractual goal needed. You don't lump sum it.
Okay, don't you like it, folks out there? When I get Stan really riled up, I can get him riled up like
makes me
well.
we see the horror stories.
Stuff. See what happens. All right, now.
I know.
Okay, calm down, Stan. Calm down. Now it's a Terry Savage podcast now for a minute. Okay, great. Stan. So someone comes up to you and says, "I'm a financial advisor." They could be with a big name firm, by the way. They could have their own advisory firm.
Sure.
They come in all shapes and colors.
Yep.
I would say you would not want to put more than 20% into an annuity. But
you can't say that. You can't say that. You,
And into an
again,
immediate.
use the least amount of money
All right,
possible to solve for the contractual goal. That could be
okay.
20, that could be
That's
7, that could be whatever.
yeah. But we're not, there's two kinds of annuities they could say to you. Okay. One of the things they could say to you is, all right, we'll take 20% of your money, and at this amount, it'll give you X, $1,000, $1,500 a month for life. Won't you be happy having that? Your Social Security, you're probably pretty well okay. But that's not the kind of annuity they're offering, is what I'm hearing from my readers. It's not like an immediate annuity, which makes you feel good because on the 14th or the 9th or whatever day of the month, you get $1,850 and your Social Security comes in and you go, okay, at least I'm okay, except for inflation on that immediate annuity. But they're now offering kind of sophisticated annuities with bonuses and guarantees. And if you do it now, you can lock in the talk about the annuities that they are trying to sell you, not the
Well,
immediate.
typically, the annuity industry has many different types, and the more simple the annuities, the lower the built-in commission. All commissions are built in.
Right.
The more complex the annuity, the higher the commission. The longer the surrender charge, the higher the commission. So if someone's showing you a 10-year surrender charge, that means it's a very high commission product. I mean, it's bad, but it's amazing how that's what they show you regardless of what you need. I always ask people 2 questions. What do you want the money to contractually do? And when do you want those contractual guarantees to start? If you say we need income right now, that's an immediate annuity. Anyone else trying to sell you another product and say, buy this indexed or variable annuity with an income rider and turn it on right now, that is a problem. Okay. That is horrific. And that should never happen, because you're getting charged a fee for the life of the policy. Immediate annuities have no fees. And once again, you're shopping for the highest contractual guarantee, period. So if your answer to that, Stan, I need lifetime income, need to start it now, the immediate annuity is going to be the highest contractual guaranteed payout, period.
And no one comes to you selling those. This is the critical point. You can go to Stan's website and he'll tell you, well, we've got this AAA rated company and this A minus company, and you know that the difference is very little. You're, as you say, married to them for the rest of your life. We want a good, highly rated company. And here's a couple of quotes, and we think we could get you $1,850 here or $1,837 here. And I think, this company's okay. But nobody calls you up to sell you an immediate annuity because there's really not a hunk of commission in there. It's not worth their time.
You're never going to go to the bad chicken dinner or expensive steak dinner seminar and someone talk about immediate annuities, ever.
Nobody ever
happen. It's never going to happen.
You gotta go find him. Stan will help you find him. All right. So, but all the salespeople that are out there, I'm going to choose my words carefully. What kind of junk is it that they're selling you as you roll over? That you come to the chicken dinner at the Algonquin Hotel, we'll show you how to have lifetime income and guaranteed no losses and a bonus and a 8% something up front, whatever it is.
Disclaimer about indexed annuities: they're CD products. Okay, they're put on the planet to compete with CDs. We use them as efficient delivery systems for income rider guarantees when you need income to start down the road, 5, 6, 7 years down the road. They're not one size fits all. They're not market upside with no downside. They're not market participation with principal protection. Upfront bonuses that's not real money. If it sounds too good to be true, it is.
Wait, what are they selling you out there? What are the word? Well,
okay, here's the sales pitch. With this, you're going to take your money, and we're going to immediately give you a 20% upfront bonus. And then you're going to get market upside with no downside, and you're going to get free long-term care, and you're going to get a lifetime income stream at the end. Only one of those statements is legitimate, and it's the lifetime income at the end when you decide to turn it on. But that income rider comes with the fee for the life of the policy. The market upside with no downside is fraudulent, in my opinion. The long-term care is not true. Long-term care is a health insurance product. Index annuities are life insurance product. And the upfront bonus is not free money. There's no philanthropists at annuity companies. It's part of the overall contractual guarantee. It means nothing. So all of that are what I call shiny things. They're shiny things.
Yeah. And at the end, when they say you're going to get lifetime income, they decide how much it is.
No, it's a contractual guarantee. And when you go to we have the only income rider calculator on the planet at my site, theannuityman.com. You can shop all income riders. See, again, getting back to the two questions, what do you want the money to contractually do and when do you want those contractual guarantees to start? If you say income in the future, we're going to quote deferred income annuities, QLACs, and income riders, and then we're going to choose from the highest contractual guarantee and explain those strategies to you. It's really that simple. People need to realize annuities are commodity products. Not one company is better than the other. Hate to say it, not one product's better than the other. And these quotes change like a gallon of milk every 7 to 10 days. So you have to quote for the highest contractual guarantee. It's like buying a plane ticket. If you're out there shopping for a plane ticket for the best deal, you're going to shop all carriers. It's the same thing. So that's getting back to the original question about the 401ks. If there's only 2 or 3 carriers in there, then we're not shopping all carriers. Going back to the second question, well, these guys are trying to sell you one product. Well, if he's trying to sell you one product from one company, we're not quoting all carriers. So again, these are commodity products. You shop them, you own them for what they will do, not what they might do. If you never make a decision to buy an annuity of any type on the might do, on the hypotheticals, theoreticals, back tested, I'm trying to get rid of back tested numbers legally. I hope I can do that before I die. Never buy that. Buy the contractual guarantees. And I always tell people, if you buy the dream, you're going to own the contractual reality. Trust me.
Okay, folks. Now, okay, I've written a couple of books. Stan's helped me with my annuity chapters. He will vouch for that. I get it basically. But I want to tell you, if that blew your head, that's what those free lunches and dinners are all about. Nobody would take the trouble to sell you this product. Look, what are your choices? You roll over at retirement, you roll right into Vanguard. In fact, if you go to terrysavage.com, there's an article, just search in the columns, rollover. I wrote about a year ago, rollover now. Here's how you do a direct rollover. Go to Vanguard, go to Fidelity. You don't even need an advisor there. You don't want to stay in your old 401k because it's got products and funds designed for young people who are accumulating and taking risk and are still contributing. Do the rollover directly to a low-cost place like that or Schwab, and then pick some mutual funds. You don't have to be a genius. Some in the S&P 500 index. Look, it's worked over the last 40 years, okay? Some maybe in an equity income fund.
Buy CDs, buy 4%, 5% money markets. I mean, buy whatever.
Exactly.
But you don't have to buy a packaged product. What I want to tell people is think of the bad chicken dinner, steak dinner seminars, because we're getting ready to go into what I call seminar season, where the postcards are going to fill your inbox and you're going to get invited to steakhouses that you would have never gone to, but now they're going to buy you a steak. Think about it like this. If you went to a medical seminar and the doctor stood up there and was talking about one drug from one company, and everybody in that room is going to get that one drug from one company, that's insanity. But yet we'll do the same thing in a financial setting, one annuity from one company and one type of annuity for everybody sitting in the room. Everybody in the room doesn't need that. I always say, if you ask a lot of annuity advisors, hey, I've got a sprain, you tell them you got a sprained ankle and a sore throat, they're going to pitch the product. They're not listening to you. You might not need an annuity. The way you say, wait a minute, Stan, you sell annuities. Yeah, I sell more than anyone, but they solve for 4 things. And the acronym is PILL: principal protection, income for life, legacy, long-term care. If you don't need to contractually transfer risk to one or more of those issues, principal protection, income for life, legacy, and long-term care, you do not need an annuity, period. And a lot of people out there do not need an annuity, even though they already own Social Security as their annuity.
Okay, now, hello, all of you. You wouldn't be listening to this podcast if it weren't for the fact that you already know about Stan and you've heard him go on his annuity rants. I call them.
Yes.
And I call them that. And sometimes it's hard to follow, but I think we can say 2 things definitively. You don't need an annuity inside your 401k. It's just don't do that. And number 2, if someone's trying to sell you an annuity at retirement, it's probably overpriced. You're contributing to the salesperson's retirement as much as your own. So don't get locked into those products.
Just ask yourself what you want to solve for. What are you trying to solve
I know,
for?
but people get overwhelmed, Stan. So I promise you, I know it sounds like a commercial for Stan. I have never, ever done a paid commercial or endorsement. Anything I say, is something I believe in. I'm going to give you another name and here. My friend Pam Kruger created a company called Wealth Ramp. Have you had Pam on?
Yeah, I have. I've had Pam on.
Okay. Wealth Ramp, WEALTHRAMP.com. It's a matching service for fee-only fiduciary advisors. They don't sell this stuff. They don't sell products where they take a commission.
Financial dating.
They will send you to Stan and say, you know, it might make some sense to do this or that. The point I'm making is anybody who's after your money, this is one of my big crusades now. My other one is fixing Social Security, but one of my big crusades is don't get trapped with that unbelievably wonderful rollover into products that will lock you up, that will cost you too much, that will pay for the salesperson's retirement. Don't get paralyzed with fear or aggressive about the fact that now it's yours to run with. Do something simple. Roll it over to Fidelity, Vanguard, Schwab. Yeah. Don't take on an advisor unless you know what you're paying for. And then you probably, and then call Stan if the word annuity comes up. Okay.
Most people, and we're going to pivot to your stuff now, but let me close with this. Most people hitting retirement, there's 3 phases of retirement: go, slow go, and no go. So when you're in go, you need lifetime income. You need that income floor in combination with Social Security, pensions, etc. So, you know, you need that. But just be careful on the products that sound too good to be true, because they are. Annuities are very, very simple. You should be able to explain it to a 9-year-old. No offense to 9-year-olds. If you can't explain it to your spouse or anyone else, then don't buy it. Period. End of story. And it's really, really that simple. And hopefully I'm making it that simple out here. I think we are, and we are kind of setting the trend and thwarting a lot of really bad sales practices that the annuity industry doesn't need. Terry, I'll close with this on my side, and then we're going to go to yours. If the annuity industry would just follow my lead with contractual guarantees only, the industry would triple.
Say that. So what do you mean, follow your lead with contractual?
If they would just look at contractual guarantees and only point the baby boomers to contractual guarantees and talk about lifetime income, principal protection, not all this pie in the sky stuff, the annuity industry would triple in size. But what the annuity industry does is they get caught up in the fancy products and the high fee products, and they focus there on the high commission products, and the agents focus on the high commission products. In my world, in a perfect world, if all annuity types were the same commission, that'll never happen. But let's just say they were, it would flush all of that out. My opinion. So, you know, we'll see where it has. So let's talk about you, Terry Savage. Enough about that annuity stuff.
Okay, but thank you all for indulging me. Thank you for letting me do that. Okay. Okay.
We're at the time of this taping, we are at silly season in political speak. Silly season.
Always at silly season in political speak.
I know.
Okay, I'll talk to you, but I want to give you 2 big warnings. Okay. Number 1 is, what do I start with? I'm going to start with bank fraud. Okay. A funny thing happened. You used to know a lot of people got scammed, right? They gave out their PIN numbers. I was like, don't give out your PIN number over the phone.
Right.
Don't click on this and give your information away. Scamming has grown to a level that is unbelievable. The latest level is the ability of them to call you on your phone with a spoofed phone number that says, you know, Chase or Wells Fargo fraud department. So you're immediately going to panic and ask you a question. Did you charge $500? Are you trying to charge $500 at a Walmart in Georgia?
Right.
And no, I'm in, you know, wherever I am. No. Now you're already second level panic. And in the process of getting you to confirm what you did charge, you happen to open the app on your account, on your phone for your bank. They're able to actually take over your SIM card and really hijack your phone. Mm-hmm. So that when your bank tries to call you up or send you a text saying, please confirm you're trying to transfer $2,500 to XYZ account. Right. You never get to click on it. They're clicking on it. I mean, to me, that's outright fraud. However, and there's a column up at terrysavage.com. I just wrote it to January 1st. The difference, the fine line between bank fraud and scam. Banks say that they are not required to reimburse you if you in any way participated in the process that led to the money leaving your account. And just by talking to these people on the phone, you are somehow expose your phone and your app and so forth to this bank. It's very, very sophisticated. There's billions of dollars. You may have seen on the Today Show, Andy Cohen of Desperate Housewives, Real Housewives fame all over the country. He was a victim to this for a lot of money. So the banks are denying reimbursement on the grounds that you participated. You didn't know. This happened to a young gal who, it was her wedding money. She deposited, she never had more than $400, $500 in her account, deposited a few $1,000s. And this is what happened. And she called me excitedly because I was working on it and said, watch the Today Show. The clip is up. If you just go to Today Show, Andy Cohen, and you'll Google that and you'll see it. So just this week, just in the last few days, the Attorney General of the state of New York filed suit against the big banks saying, you're supposed to be protecting them, and you are unfairly denying them reimbursement because of this fraud. Now, we will see how this plays out. I talked to the banks. They said, look, you know, if you were, quote, dumb enough to know to use those words, to fall for this in any way, shape, or form. The fact is, it's gotten very sophisticated. So here's 2 warnings. I don't care if you get a text or a phone call and it looks so real. Hang up. Contact your bank directly, the number on your statement, on your online account, on the back of your credit card, and say, I've been contacted. Is this for real? They will say, no, it's not. Number 2, make sure your phone number has not been cloned or calls forwarded or text forwarded. So ask a friend of yours to send you a text to make sure you are receiving text and your phone hasn't been taken advantage of. Be very, very careful. It's billions of dollars in sophisticated stuff that's going on, and you will not be reimbursed by your bank if, in fact, money is wired out or sent out, and you in any way answered a phone call or a text. They're not going to pay you. Okay, we'll see how that lawsuit in New York works out.
That's, I mean, all of the phishing, PHISA, all of that is pretty scary. I just would tell people, don't overreact. Think through it, slow the game down, and then make rational decisions. Don't panic, period, because it happens to all of us. I see so much coming through. I'm like you, I'm so aware of it that it doesn't get through, but a lot of people aren't. And a lot of people aren't sophisticated with all of that. And the one that scares me, Terry, is the deep fake voices that they're doing now, where, you know, your mom, they'll take my mom's voice and clone it like they did the Biden thing the other day for the robocall. That's going to happen a lot more often. And I think, you know, artificial intelligence, good or bad, is going to take us down that road of fraud. And I'm sure the fraudsters are already on top of it.
Yeah. I mean, so this is, tell your, you know, you're watching because you're sophisticated. Tell your kids, your kids are in their 20s if you're not one of them. Tell them about this stuff. They think they're so smart about technology, but you're right, and it's growing and growing. And let me give you one that really has bothered me for a couple of years, and I've written about it. Right now, you know, Medicare open enrollment closed at the end of the year, December 31st, 2020.
Right.
Half of America has been, of those on Medicare, have been, I'm going to say this, conned into Medicare Advantage.
Right.
You saw the commercials about, you may qualify, call now to see if you qualify for rides to the doctor and free dental and free vision. Now, look, I wouldn't be telling you this story now since it ended in December, but we are in the middle until March 31st of an opportunity to switch out of Medicare Advantage and back to original Medicare. And here's the breaking news, again, just since the first of the year. The really worst thing about Medicare Advantage, which you don't know, because it works fine as long as you're well, but when you get sick, you are limited to referrals to doctors in network, hospitals in network, and tests that are approved by this Medicare Advantage plan. Now, this is hysterical. A couple of nights ago, do you watch Chicago Med? Or
No,
Chicago?
I don't. I'm not a big
Well,
TV
I do.
person.
Well, I'm a
Okay.
Chicagoan. So
Okay.
and guess what the Chicago Med thing was all about? I was jumping up and down on the couch. It was about a patient that didn't get a scan early on and didn't detect the cancer because the managed care insurance wouldn't let him take the scan. And now there was some surgery. No, he's dying anyway. Just put in a breathing tube, and it could have prolonged his life. Managed care is, you talk about AI, that care is now being managed by AI decision makers. Your doctor might say, I want you to have the CT scan or an MRI. If you have that kind of advantage program, don't tell me that yours works fine. I'll come back to that, answering that. If you have that kind of advantage program, those insurers are going to make decisions based on profits. Now, here's the headline news. Just in early January, Humana came out with its earnings, which were a loss, and also predicted that 2024 wasn't going to be so great, and 2025. And why? Because of the costs. They're one of the largest advantage insurers because they get reimbursed a set fee per patient. And when the people start using the care, it uses up their care and all their profits, and they actually turn to a loss. And they're a public company. Their stock fell like 20% the day they announced their earnings. They and all the other big advantage plans, CVS Health and all of those, there's no way to tell what's a good one or not. They are all looking at the bottom line. And how are they going to swing back to a profit? Well, two ways. One is they are going to cut your ability to get tests or doctors and so forth. You have to be in their network. They're not, I don't want to get to the whole thing. They're going to be cutting back on approvals for your care. And number two, there's a new report out on over $80 billion last year that they code their patients, regular and sicker, basically when they get reimbursement from the government on a person per head. They have been upcoding more for their patients as sicker, so they get more reimbursement per person. That's still not enough to give them profits, as it looks like. But that dips into the whole Medicare trust fund, which was screwing the people that are on traditional Medicare. Okay, go read the two articles at terrysavage.com. The first one is from last fall when open enrollment was, called The Disadvantages of Advantage. And the new one is called The Advantage Crunch Arrives, as these companies, all their stocks went down because their profits are being squeezed because they spend too much on your healthcare. So they're fine when you're well. And yes, you had your hip replaced and it paid everything. That was last year. Going forward, when you're older and sicker, you don't want an AI robot deciding what treatment you should get. So switch back to traditional Medicare. If you're ill, you may not get your original supplement, but any Medicare supplement will give you the choice of seeing a physician of your choice that accepts Medicare, whereas an Advantage plan limits the hospitals, the doctors, the testing, and your care just when you're sickest and need it most. You can switch back until March 31st, and that column about the Advantage Crunch Arrive tells you how to do it. terrysavage.com. I don't sell anything, folks, anything. And like Stan, we are the two most brutally honest people out there. It doesn't always make me happy when I talk about the banks or I talk about the insurance companies, but who tells you this stuff? Who's there to tell you when you're older and making a decision? Oh, it's low, so low, and they'll drive me to my doctor's appointments, and I'll get dental. You'll get a free teeth cleaning. Is that worth that?
These
Really
commercials, Terry, these Medicare Advantage commercials, they depress me for a couple of reasons. Number one, they're the dumbest and stupidest things I've ever seen. Number two, anyone that's affected by that to take action scares me because they also vote. These are I just scratch my head. The one that had the character Martha with the big glasses and she's yelling at the screen. I'm thinking, I understand they test marketed it. I understand they did all that. I understand they know what they're doing from an advertising, but that scares the life out of me. It kind of comes back to that stat that I just read where 60% of adults have $400 in their checking account. And that scares me too, because now you know why people vote like they vote. I'm not putting down voters and I'm not higher and uppity or
Wait.
anything like that, but scares
Who
me.
do you think is paying for all those commercials? Now, just remember, the way these insurers get their money is they get a per person reimbursement from Medicare, from the government.
Right.
And they say, we'll take care of these people for whatever that reimbursement is. But not only are they not having enough money to pay for all your tests, you're paying that per person thing is going to pay for all those commercials and those celebrity endorsements. Please wake up. Half the country is in Medicare Advantage. You have an opportunity till March 31st to go back. You go back to Medicare.gov.
Did you say half?
Half, over, it's 51% now, has given, we're going to have not only Medicare traditional Part A and B and your supplement and your Part D insurance, but don't you know you need Part C? No, you don't need Part C Advantage.
Oh my
You
God.
need the supplement. Go back to Medicare.gov. That's where you can compare all the supplements. You put in your information. You can even apply directly. Then if you do that, you will automatically be disenrolled from your Advantage plan. There's no penalty to disenrolling. Please be smart and get out of Medicare Advantage. Even if it's not the Plan G, the great, that covers everything supplement. If it's one of the others that covers a little less, what it does give you is choice at the moment. You and your children want to make choices when they're standing there and you're in the hospital bed. Get her that heart monitor, get her that CD. We want the stent. I'm sorry, she's 85 years old. She's too, our AI says that won't do much good at 85, so no stent. That's the kind of stuff we're going to see in the future.
How do you think how do you think the Fed's done recently during this chaos?
The Fed's been extraordinary, don't you think?
I'm asking you. You're the one that knows all the. I mean, you actually know all the ex and former and future Fed people. So, what do you think?
Yeah, I've met all of them. Yes, I have. So far, so good. There is I've got a great guy for you to interview. I'll tell you afterwards. But Jim Stack of Investec.
And I know Jim.
Yeah, I'm sure you must know. In his latest letter, that the term soft landing has been mentioned more frequently in the last 2 years than before the last two recessions. And he points out in 2008, Bernanke, just on the cusp of a recession, was talking about a soft landing. And the San Francisco Fed president, then Janet Yellen, said that in 2008, which is right before that huge, remember the real estate recession, how could you forget that, 2008, 2009, said, we've achieved a soft landing. But so far, the Fed there's a lot that could go wrong. The most recent Fed statement was, we're not cutting rates until we see inflation under control.
Right.
Hey, stay out of politics, but the economy is growing strongly. It's the strongest economy in the world. China's in the tank, in case you hadn't looked up. Okay.
Yeah, they have.
Europe's teetering. And the American economy has low unemployment. Now we have pretty low interest rates. Come on, you can get a mortgage. Now that's the 6% area is not such a high thing. You just got spoiled at 2%. Really. And we haven't had a crunch yet. What could go on in the spring? Well, and consumer confidence has bounced back dramatically. What could go wrong? I think the soft underbelly is the commercial real estate market, which, as the leases expire that were made in previous times that allowed the commercial real estate owners to carry on and pay their loans, and as the original low-cost loans expire and have to be refinanced higher, I think if I were looking into March and April this year, I think that the commercial real estate market, and by the way, nobody's going back to those offices, or I mean, half the people aren't. So commercial and office real estate has a very soft, thin layer of ice that they're walking on top of. And to me, that would be the big thing. But so far, so good. And I think the Fed has acted with admirable restraint. But there might be economic forces that.
Yeah, I think he's done well. Another question? ETF, the Bitcoin ETF. What's your take on that? that just got released and approved, and people are buying it. You know,
Okay,
Bitcoin's
all right.
been interesting because the Sam Bankman-Fried innocent until proven guilty issue has kind of been swept under the media rug,
Yeah,
for a lot of
yeah.
reasons. We know why. But what do you think about kind of Bitcoin going mainstream?
Okay, well, let me start by this full disclosure.
Hmm.
I'm on the board of directors of CME Group, the world's
Sure.
largest exchange, and we've had Bitcoin
Right.
futures for 3 years. There was never any complaint. Future prices based on the spot Bitcoin price.
Sure.
What got the dark side of Bitcoin was never the idea of a alternative currency, if you call it. The blockchain technology was
Sure.
never a problem. What was a problem was the people that got into the business. It was the
Yeah.
wallets and the ability to lose your money if you forgot it, and the ability for the wallets, and these, they called them exchanges, but they weren't exchanges, to have loose security and have money siphoned out of your account. That what was wrong with Bitcoin. And in the last 4 years, Bitcoin has really been a speculation. Gold is a speculation, for
Hmm.
example, and gold's
Sure.
been going up. But all the gold ever mined is still around. It might be in ships at the bottom of the sea. Well, Bitcoin is going to be halved, but if there's a limited supply of Bitcoin, there's a column I wrote. That's why I'm on top of this just
Hmm.
recently. And now they have made a legitimate way to trade the price of Bitcoin like they trade the price of gold. I'm not comparing them because gold has some real uses in jewelry, and for 2,000 years of history as a store of value. Bitcoin has a dozen years, and it's been from 16,000 to 67,000 to 18,000 to 40 something thousand
Right.
now. And so nobody would consider it a store of value because it's so volatile. Gold hasn't been so great in the last few years either. What they did was legitimize a legitimate way that existed already of pricing spot Bitcoin and giving investors access through it, just like the GLD is the gold fund that trades based on
Hmm.
the price of gold. So
Hmm.
they've created ETFs. If you want to have something to talk about at dinner, fine, but that's a pure speculation. That isn't, you want to keep your eye on it, great. This is not where your retirement funds go in mass. This is not to save us against the end of American dollar, because the American dollar will be around. It will be digital. It is already digital. I don't even take coins pretty much in my wallet anymore. I don't know
No,
what
I
to do.
don't either. No, I haven't
You know,
for a long time. Yeah.
yeah, exactly. So we live in a digital world. So the idea that we've already had Bitcoin futures, the regulators were very remiss, both particularly the SEC, on dealing with allowing responsible people to create a vehicle for
Right.
speculating the price of
Right.
Bitcoin. Now they've given one, and you can speculate, but don't think it's an investment. It's a speculation.
No, I agree. Well, we gotta kind of wind this up. Obviously, we go 100 miles an hour or so. Any words of wisdom? You know, I always say mic
Oh,
drop moment for my guests like you that you know, you've given a couple of really good ones from the standpoint of the bank and the Medicare stuff. Anything else that's on top of your mind right now,
yeah.
Terry?
Don't get lured in. I think I never have made a reputation on the stock calling turns in the stock market. I've always
Right.
said you beat the market. All you have to do is beat the market. But those of you who know, I created many, many, many years ago 3 categories: the bulls, the bears, and the chickens. And I remind you that everybody should have chicken money. Now,
Yeah, man.
Treasury bill interest rates are coming down. Their 6-month bills are a little over 5% as we talk. They were over 5.5% a couple of months ago. But with inflation, maybe down under 3%, you're getting a 2% real rate of return. And never get so enamored of the headlines and the proof that there isn't going to be a recession and for sure the market's going higher. Keep some chicken money on the side. Right now, if you do it correctly through
Yeah.
treasurydirect.gov, 60
Yep.
bills, you're getting a nice real return on your money, and
Yep.
you sleep better, and you don't make other dumb decisions when you can go, oh yeah, but at least I've got that and it's safe.
And
That's that.
the top four chickens and the chicken money, treasuries, CDs, money market, and remember MIGAs, the industry annuity industry version of a CD. So all of those are principal protection, no annual fee, guaranteed interest rate products for your chicken money. And I like chicken money. So, Terry, once again, thank you so much for being on the podcast. Hope that our paths cross in the future when I'm Learjetting into Chicago. Not, but
Not this month anyway, for sure.
not this month. But I really appreciate you being on. I appreciate everyone joining me on the #1 annuity podcast on the planet, Fun with Annuities. My name is Stan, the Annuity Man. See you next time.